on.
Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. Ooh, we have a big one. This is something that we have been waiting for weeks and weeks, and it is finally upon us. The fateful quarterly June FOMC announcement. Of course, the Fed makes announcements more often than quarterly, but it's the quarterly meetings that tend to have the biggest impact, because not only do we get the Fed policy announcement, the statement, the press conference, at these quarterly meetings in the June, September, December, and March Fed announcements, we also get a summary of economic projections. We get a dot plot that tells us where members of the FOMC, the steering committee here on rates, chaired by Chair Powell, where they are going to see rates going themselves over the coming year or two. And so that's everything that's coming together for us over these next 24 hours here. We're going to unpack it all. We're going to see what is going on here with policy expectations, how markets are likely to react, what it is that we could see in currencies, in commodities, in stocks, of course, and what that might mean going forward in the weeks and months ahead. So let's first take a look at a bit of review. Obviously, we come into this announcement having seen U.S. inflation data, needless to say, a critical input into the Fed's thinking just today. Here's where that left us. Headline CPI a little bit lower than anticipated, 4% versus 4.1 expected on the headline year-on-year rate. The core, though, a little bit hotter than expected, 5.3 versus 5.2%, down from 5.5. Did that change anything in the Fed's thinking? Well, here's a breakdown. What the core number pointedly excludes is food and energy. Now, what you see on this chart, that little bit of yellow on the bottom that you see there, that's energy, which after recent declines is actually now a disinflationary force, not an inflationary force. Not only is it not positively contributing, it's actually detracting from inflation at this point. Food, you can see, is fairly steady. That tells you a story about the difference in the way commodities have behaved in recent months. Soft commodities up, energy, as we can clearly see here, down. We likewise can see here that the goods part of the equation has started to widen out just a little bit. That tells us maybe some positive news about consumer demand, maybe some positive news about the business cycle, but certainly not positive news for inflation. That wedge has widened out a bit. And of course, the biggest component, not surprisingly, services. Services, of course, 75% of the overall economy, so no big surprise there. But we can see those costs holding sticky. And that's really the meat of what is going on with core CPI, really not falling as quickly as the headline number, where in particular energy is a factor, would seem to suggest. And so what we have then is a situation that ostensibly hasn't much changed before this number versus after. What is that situation, you might ask? Well, let's quickly catch up. What we're looking at here is the expectation for policy in June in the dark blue line there. The red is where we're going to be in December of this year, as implied in Fed funds futures. So this is market expectations. You can see these lines have essentially met now. And so what you're looking at is, at this point, a spread that has all but fully closed. Notice that at the beginning of May, we were looking at perhaps as much as a full percentage point in rate cuts at the end of the year. So consider, over here, the spread between December and June was so wide as to suggest that between June and December, you would get this many cuts, as is shown here by the gray bars. You can see that falls right in between 1 and 0.75% in cuts. You can see that over the course of May, as these policy expectations for the end of the year have factored those cuts out, the gap is closed. And so now it looks like we are going to essentially end up at standstill on net for the year. Now, we can, of course, surmise what this was all about in May. We see that really the story here has worked in primarily 4 acts. The first one is the run-up at the start of the year. You can see here policy expectations getting more hawkish as the data gets a little bit hotter. Over here, we hit a kind of pain point. We get the SVB banking crisis. Everything comes down. Policy expectations crash. Rate cuts significantly factor into the outlook at this point. You're about resolved on that issue, it looks like, by around the middle of April. But then, of course, the debt ceiling situation starts to worry markets and rate cut expectations build back out. And then from the beginning of May, that too clears away. Ostensibly, the markets concluded that the debt ceiling was not going to be a major source of fiscal drag as early as the beginning of last month, even though the markets were constantly getting barrage of commentary from politicians, from every journalist corner one might come up with that covers these things, suggesting that a tremendous amount of uncertainty remains, that it could really go either way, and people were seriously entertaining the idea that it's possible for the U.S. to default, and that it's possible for the markets to price in such a thing and therefore to react as though a default could be something of an investable thesis, meaning it could be something that one could say, well, if the U.S. defaults, the correct level on the S&P is X, or the correct level on the dollar is Y. That, of course, I've made no secret of my view there. I think that's a ludicrous thing because, of course, the current financial system as we know it takes as given confidence in the faith and credit of the U.S. government because the U.S. Treasury bond is the risk-free asset baked into every which valuation of financial assets, derivatives, funds that you can possibly imagine. And of course, the US dollar is the quintessential global reserve currency. And more importantly, even than that, the quintessential medium of commercial exchange worldwide, without which there is no global economy as such, because there's no medium for that global economy to transact. So in a world where both of those things rely on the faith and credit of the U.S. government being untarnished, you wouldn't have a financial system, as we know it at least today, without that assumption holding. So really, this was about how much fiscal drag this debt ceiling deal was going to exact on the economy. Was it going to bring more spending cuts than could be palatable, or perhaps some tax hikes, or perhaps it could drag longer? And so the government, in passing through a deadline, might need to hold back some spending until a deal was belatedly wrapped up. None of those things were worries for the market, though. The market concluded, seemingly, as of the beginning of May, that this was not going to be a big deal. And so we see this steady factoring out of any offsetting rate cuts that the Fed might have had to do in the face of an adverse outcome. And we are now at this point, at the fateful June FOMC announcement, having dispensed with this risk until after next year's election cycle, at the very least. We can see that shift show up in the curve, and in particular, at the 6-month and longer part of the policy curve. So you can see the current curve in solid there is meaningfully steeper than the curve we had at the last FOMC announcement on May the 3rd, and even meaningfully more hawkish than the curve we saw just a week ago, in particular for the 6-month to 3-year window. So the message from market expectations here seems to be the view from the Fed is higher for longer. And this is how it all kind of shakes out. So for this meeting, the markets see a meager 14.8% probability of a hike. You can see here in the implied rate delta column, just 4 basis points of a 25 basis point hike are priced in. In July, the cumulative probability of a hike between June and July rises to 74%. You can see that in the number hikes cuts column, you have 74 of one hike. So 74 out of 100 baked in by then. You can see the implied rate delta gives you a 19 basis points of the 25 basis point hike in July. If you add to that what you see in June, you can see you're almost priced in at that point. Then by September, 83% of one hike are baked in. So again, these are cumulative numbers relative to now. This is not saying that we're going to get hikes at both July and September meetings. What this is saying is that by September, one hike relative to where rates are currently is fully in the market. You can see by then in the implied rate column, you're looking at a rate of 5.28. That's obviously north of the 5.25 upper range for the current policy target. It's between 5 and 5.25. 5.28 is north of 5.25. So that tells you you've had just barely one hike. The give back begins December, January. You can see that by December, rates haven't changed relative to now. And there is, at this point, a 5.1 implied rate. So you're back into the current range. By January, you're flirting with the possibility of maybe a cut. But at the very least, that cut that was there earlier in the month and even toward the end of May now seems to be gone. So the market seems to think that we are going to have a hike here sometime by September, and we're going to give away that hike by the end of the year or January or so. That essentially we are now at the place where we're going to be at the end of the year. And that there's going to be an intervening hike in the middle there, which the Fed is going to have to undo. Now, from the market's perspective, all this is just fine. You can see that as policy expectations have been rising from the lows at the SVB crisis bottom, so too the S&P has climbed higher. That's the yellow bars there, the dotted line there, just a moving average, a 5-day moving average, so that we can get a clear sort of direction on what's going on. So Here we have a market that's seemingly sanguine about the idea that the Fed has gone from going to cut rates by 100 or 75 basis points from the second half of this year to none of those things are going to happen. We are now going to end up basically where we are currently, and the market seems to think this is perfectly okay. So the tightening does not seem to have spooked anyone. Now, is it tightening in fact versus the absence of potential easing? Well, you might say that's the same thing. Because what this is telling us is that interest rates at the end of the year, for which markets have to make provision ahead of time, because markets are, of course, forward-looking, they've gone up by almost 1%. And the market doesn't seem to think this is a big deal, or seems to think that, at the very least, this is not a problematic thing currently, which is, of course, very different from where we were at the start of the year, where you can see there, February going into March, rising Fed policy expectations were hurting stocks. There was a sense there that what is going on is a business cycle that's ramped up to an economy that's too hot, and a Fed that needs to hurt that economy to keep inflation moving lower. Now, of course, hurting the economy is no good for corporate earnings, and so stocks go down there. What we seem to have from the March bottoms after the SVB-led banking crisis up through now is a perpetual factoring out of tail risk. First, the banking crisis, which is on the back burner at this point. It may reignite again. I frankly think it's a fairly good chance that it does, but the markets aren't worried about it here. And then, of course, the debt ceiling. So it seems like equities are less so worried about the restrictive implications of policy, more so worried about what some of these tail risks could have done to shock growth into sort of a particularly bad situation, and the unwinding of those fears, as reflected in the erasing of these rate cuts from the outlook, seems to have encouraged markets rather than discouraged them. And of course, now we enter, among other things, a meeting faithful for many reasons, but also because these risks seem to be off the table as the Fed decides this go around. This, of course, presents a bit of a conundrum, because what we have here is, on the one hand, a path toward the Fed's target, or close to it, that's seemingly visible. If we look at the current setting for market expectations, it's a little bit warmer than what the Fed would like. So the 2-year break even we can see at 2.2. That's the bond market's expectation for inflation. It's derived by taking the difference between nominal and real, or TIPS, yields. Once we take that difference, we can get the inflation adjustment factor as residual that the bond market is implying in order to get from nominal to real. That, of course, requires discounting inflation. So if we take the difference in the yields, we get the magnitude of that discount. And over a 2-year period, that's now 2.2%. So that's where the market thinks the Fed is going. Now, given a CPI number at 4 that we just saw earlier today, that's meaningful progression in the right direction, one would think. The 1-year swap suggests that actually most of the disinflation is going to happen relatively quickly, over the next year or so. That's at 2.3%. The numbers here are a little bit warmer than the Fed would like. Of course, it wants to get to 2. But it's certainly seeming relatively benign. The problem is the direction of travel. What you see here is that over the past several months, almost going back to the middle of last year, inflation expectations have stopped falling. And what we see here is that they tend to lead CPI by about 2 months. In fact, you can see I've pulled CPI back 2 months here to show how they line up with each other when you factor out that CPI is lagging. So the concern becomes, if things have stopped getting moving on inflation expectations, you are effectively priced for perfection, which means that you're going to get just within a hair of target if nothing about the current trajectory is going to change over the next 1 to 2 years. Now, what's the likelihood that that's going to happen? But in my mind, it seems relatively low, especially since we're going to have an election year in the U.S. next year. So what we end up with then is something of an issue for the Fed, because the market doesn't seem to think that whatever's going on now is enough to keep inflation expectations going lower. First of all, the last bit of the road to the target. Secondly, to give the Fed enough of a buffer to where if it looks like inflation expectations 1 year forward are now off 2%, or 2 year forward are off 2% on the downside, then the Fed can cut into those rising. Otherwise, what seems to be happening here is the market has stopped believing that the Fed's policies, even in their cumulative form, are enough to keep inflation expectations down. And with the resolution of the debt ceiling situation and the remission in the banking crisis situation, it seems like the markets are no longer willing to take continued disinflation at face value, at least beyond the current level. And so there's a risk that inflation might get stuck if inflation expectations anchor. And if they get stuck, well, then, of course, all of the stickiness in inflation that the Fed wants to avoid is where we get left. This is not the policy outcome the Fed wants, quite the contrary. You can see it in spades here, that as Fed policy, even over a 12-month forward view, this is not just December, this is 12 months forward from any given day in the orange line here. So what that's telling you is the Fed rate that's expected in the middle of June of next year. You can see we are just at about 4 3/4. So a mere 1 cut relative to current levels now imply 12 months from now. And amazingly, over that time, the 2-year break even doesn't just hold steady. It actually manages to edge up some. What this is telling us is that as these rate expectations, even 1 year forward, are rising, inflation expectations are not responding on the downside, which is not what the Fed wants to see. Now, how do you get this inflation? How do we fix this? How does the Fed get things moving again in the direction that it wants, to make sure that inflation expectations aren't sticky and to make sure that it delivers on its mandate? Well, it's certainly not going to be through efficiency gains. We've made this point before. What we have here is a situation where there is seemingly all the juice already squeezed out of whatever there was to be done. We can see the Baltic Exchange Dry Index, which is a benchmark for shipping globally, that's down to pre-pandemic levels. So a lot of those pandemic-related supply chain disruptions that were inflationary in the system seem to have been squeezed out. We also see that a lot of the readjustment that had to happen, in particular because China reopened close to a year later than everybody else. Of course, China is a huge center for value-add and intermediate goods production, and a huge part of almost every supply chain you can think of, for almost everything that you can think of to some extent or another, either along the way or at the finishing stage of production. And of course, people had to readjust. So there was a fairly significant and lingering spike in intermediate and final distributive services costs. In other words, the costs to distribute goods around the supply chain, from the place where they begin to the place where they go through their various finishing stages of production, from one spot to another, and of course at the end, where they go from where they're finished to where they'll be sold. Those adjustments seem to have been made. those costs are no longer rising at anything like the clip they were rising. In fact, the pace at which they've been rising has utterly collapsed, is now hanging up just above zero, and is now toward the low end of where we were before the pandemic. So we're not going to get this inflation by efficiency gains like we have been in recent months. Instead, it's probably going to have to come through economic pain, and in particular, through the addressing of the supply-demand imbalance in the labor market, where we can see still that labor supply is falling short of demand. What we have on the supply side here is the number of people employed or looking for work. So basically the U.S. labor force. If you're not looking for work and are unemployed, you're not in the labor force, reasonably enough, because you're not looking. Let's say if you're a student or you're retired, say. If you then look at the demand picture, that's the number of people that are employed, plus job openings. So the number of people that businesses want to be employed. You can see there the gap is still stark, still very much reeling from the after effects of the pandemic. And of course, this factors into everything. Because the only way for companies to make sure they have the labor they need, given this scarcity, is to compete on price, which just means wages. And so if you then have higher labor costs as a consequence, that of course filters into the price of everything else. If something is more expensive to make because labor is more expensive, be it a good or a service, whatever is sold, then that's inflationary. That impacts people's bottom line. Those people then go to their employers and say, well, my cost of living has gone up, and demand higher wages or trade up to other work for higher wages. That, of course, becomes a sticky inflationary spiral. This is precisely why what the Fed probably needs to do here is hurt demand for this labor. That, of course, means slowing the economy, such that businesses aren't as eager to hire, labor supply comes closer in line with demand, disinflation continues. And in this sense, we can see why the Fed appears to not have exactly the responsiveness from markets that it is wanting. Because if we see here what's been going on with U.S. economic data, most recently, in particular from May onward, it's actually looked better. And that's on top of the debt ceiling situation being factored out, on top of the banking crisis going in remission, at least for now. We can see that the City Economic Surprise Index, which measures how economic outcomes register relative to baseline forecasts from the majority of market economists, or at least a representative sample of market economists, which we put together by the likes of a Bloomberg or a Reuters, there you can see data is actually outperforming relative to forecasts. In fact, it's actually broken the 20-day moving average, which is just the monthly trend in data outcomes relative to forecasts, of course, again. So we can see here that when we tend to break this, notice in February we did something similar, it tends to have a bit of room to travel. And so we look like economic data is pointing to a hotter economy and to the Fed's issues being compounded in that expectations still remain locked in place. Now, that of course raises the question, could the Fed and should the Fed start to turn the screws? We said before, there is only one hike expected for the rest of this year that then is promptly given back by the end of the year. And with all of that already expected, it doesn't really seem to be working how the Fed would like. Because inflation expectations, as we said before, don't seem to be responding to rate cuts falling out of the outlook. So perhaps the Fed needs to demonstrate seriousness. It certainly has cover in terms of the banking crisis The debt ceiling, of course, is resolved until after the election by statute, but one could certainly see another situation like February where the heating up of policy expectations is going to knock something over, and we might be right back to seeing banking stress recur, but the markets don't seem to think so. Looking at the recent build in policy expectations, that's the 12-month view there, and I take that versus December to just make sure that we are looking far enough for something that the Fed would find relevant. And we can see that as those policy expectations have built after the recent issues, as they've recovered toward 5%, the OFR Financial Stress Index, which is a broad-based measure of credit risk in the market, that's actually fallen. So the market is plainly not concerned here. We see that in spades with how equities have performed against the backdrop of that same rebuild in 12-month expectations. Equities seem to think this is perfectly fine. And of course, what that suggests is the Fed might well look at it and say, well, so the market thinks the current amount of tightening is not restrictive enough, clearly, because credit stress is down, so the market feels that monetary conditions, financial conditions are loose. Stocks are going up. That's only a further loosening of those monetary conditions because higher asset valuations allow people to use those assets as collateral to buy still more assets. That's a self-reinforcing kind of thing. And of course, what the Fed is after is tightening, not loosening. So this speaks directly counter to what the Fed is trying to achieve. And so if ever, seemingly, there was a time to surprise markets and jolt them out of this rose-colored complacency, this could very well be it. Now, we have the example last week, very telling one, from the Bank of Canada, which found itself in much the same sort of situation, and for obvious reasons. Canada exports 73% of everything they sell to the U.S. Almost all of the population lives within a stone's throw of the U.S. border, and until very recently, various Canadian provinces had freer trade between themselves and the U.S. than amongst themselves, which is quite telling. The U.S. is overwhelmingly the driver of Canada's business cycle. Here's the situation that Canada found itself in, much as the Fed finds itself currently. Inflation expectations were falling, disinflation was progressing, and then things stalled. The way that the Bank of Canada read this, listening to Governor Tiff Macklem over there, is that we run the risk, since expectations have stopped moving lower, of having inflation bake in and get sticky above target. And that's an issue. The economy has turned out to be too hot, so policy needs to be more restrictive. Very tellingly, the market noticed the implications for the Fed because, of course, if the Canadian economy is too hot, the question is why? And if Canadian demand primarily is dependent on U.S. demand and it's too hot, well, then U.S. demand is too hot. And indeed, what we see here for Canada is much the same as what we see right here for the Fed. It's about the same story. So how did the markets respond when the Bank of Canada surprised with a rate hike last week, having about the same odds going into that meeting, a little bit higher than what we see today for the FOMC in this meeting? Well, the Canadian dollar, of course, rallied. That makes sense. But with it rallied U.S. yields. And it's the Fed's policy outlook that got more hawkish. So the markets clearly are perceiving that Canada might be the canary in the coal mine here, that it might be tipping off to a more hawkish Fed than the markets anticipate. And so we could be in for a surprise hike that hurts stocks, boosts the U.S. dollar, hurts gold, because, of course, higher rates make an asset that yields nothing less attractive. That goes doubly for crypto and other non-yielding assets. You can look across the entire commodity spectrum for things that are examples. The dollar here seemingly positioned to regain a lot of vigor if this is what happens, both as risk aversion fuels demand for it as a liquidity haven. When people cash out, they want the most liquid thing because that's the least volatile. And the most liquid is the US dollar. But also because borrowing costs on the dollar might need to get revised higher and have been getting revised higher. In fact, yields have been going up. Cuts have been falling out of the outlook, as we've seen here. But it hasn't responded yet because risk has held up, so you haven't had that liquidation dynamic. You could get there if the Fed surprises. Now, even if it doesn't, though the ingredients and the lead-up seem to be there, it could nevertheless signal its intentions to be more hawkish via these economic projections. And you can see here where that would come. Looking at the latest projection for the unemployment rate, for example, you can see the Fed was looking for 4.5% by the end of this year. Last NFP gave us a rate of 3.7. Adding almost a full percentage to the unemployment rate over the next 6 months would imply the kind of catastrophic outturn in the labor market, the kind of aggressive mass firings that are frankly unlikely to happen. But if we look at the revision to the GDP growth number from 0.5% to 0.4%, that could get revised higher, signaling the Fed needs to do more. The inflation number could certainly get revised higher from 3.1 to 3.3 on the headline. That could get things moving. And of course, we can see now the median for the Fed funds rate at 5.1% is basically the target range where we are currently. Revising that number higher would suggest that indeed, not only is the Fed not going to take back its hike that it's going to do at some point here, tomorrow, July, or September, and again, the market still thinks July, September are more likely. But if you revise that higher, and the message you send to markets is, yeah, maybe we're going to hold right here, but make no mistake, we have every intention to be much more aggressive than you all have baked in going forward. That could certainly have a similar result. In fact, if the Fed were to hike, that would just amplify things because, of course, it's very much not priced in. If you don't get the hike, that's already in the outlook. So it's not necessarily a demerit for the dollar or a boost for stocks. And that is macro money for today. We ran a little bit long because, of course, we're dealing with a complicated and very weighty thing here in the next 24 hours. We'll, of course, be back tomorrow to unpack all of it and look to see what is likely to happen next, as we are every day, Monday to Thursday here, right after Overtime, which is a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we break down each day's events after the U.S. market close and try to see where things got and why. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays as APEC markets come alive for the week. Outside of those shows, I'm opining on Twitter at Ilya Spivak, so check that out. And I will see everybody tomorrow. Thanks very much for watching. Good luck out there. Take care.